I want to thank you all for being here. It's a great group. And I guess a potential Fed chair is here too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you.
It's now the worst-kept secret, with President Trump teasing National Economic Council Director Kevin Hassett as his possible choice for the next Fed chair. We'll hear from Hassett himself to gauge what his leadership of monetary policy could look like. Traders await the last few U.S. economic reports before next week's Fed and BOJ decisions. Meanwhile, Bitcoin bounces back above $90,000, though the move lacks conviction. We'll discuss what's driving the crypto downturn with Melvin Deng, CEO of institutional digital asset trading firm QCP. As geopolitical and trade tensions rise, we examine how Italian exporters are navigating the tough climate with the chairman of Italy's export credit agency, SACE. And India's booming IPO market faces slowing approvals from the regulator. We get a view from the CEO of Asia's oldest stock exchange, the BSE. Asian markets fluctuating today as volatile trading in cryptocurrencies remains a key focus. Bitcoin resuming its slide after rallying back above the $90,000 level overnight. Investors are also bracing for the final rate decisions of the year from the Fed as well as the BOJ. Bets in the U.S. futures market are growing that President Trump's pick for the next Fed chair and delayed economic data will all support his calls for lower interest rates in the coming months. Speculation has intensified since the White House National Economic Council Director and close Trump advisor Kevin Hassett emerged as the front runner to succeed Jerome Powell. Trump, as you saw earlier, made very direct hints that Hassett is his favorite choice. Well, Hassett says he told President Trump he would accept the nomination if he was offered the job. In an interview recorded on November 12th, he told Carlyle co-founder and co-chairman David Rubenstein that he has high regard for Powell, but does not always agree with the current Fed chair's policy.
If you look at a chart of inflation, that it's a time series that has quite a bit of momentum. And, my friend I used to work with at the Fed, Alan Greenspan, used to say that, like, dealing with inflation is like steering the Queen Mary. They don't even have a Queen Mary anymore. I think they have a Queen Mary too. Kind of dates poor Alan. But the fact is that if you look at it, then what happened is that in the Biden administration, it got very high, averaged 5%, was still in the high threes when we came in. And now, like, if you look at the latest CPI, it surprised, 48 of Bloomberg's people who forecast these things on the downside. If you adjust for a refinery that shut down, then you're kind of looking in the 0.2 range. And so I think that inflation isn't all the way to where you want it to be, but that the momentum is pretty directional. And so I think that if you add to that the basic idea that the policies that we're pursuing right now are increasing supply, their supply side policies, then you should expect that we could have growth like we're seeing without picking up Phillips curve effects in inflation.
So you may have noticed the president was calling on the chairman of the Federal Reserve to lower interest rates. And
really? He did?
Yes, he did. Oh. And interest rates have been lowered. The last time the Federal Reserve FOMC committee met, they lowered by 25 basis points. There's a wide expectation that the Federal Reserve Board might lower again in December. Do you have a view on whether, if the Fed does lower it, should be 25 basis points or 50 basis points as the president, or do you have a view on what might be better for the economy?
Well, I first want to say that I have high regard for Jay Powell. I've known him for a long time, have had economic conversations with him many times during the last administration and this time too. And, I think at times he and I have had policy disagreements, but that's where it is. And I think that an example of a policy disagreement that Jay and I might have is that, I sort of agreed with the previous two meetings that it was the right time to cut rates. And then after the last meeting, the sort of two things that happened that surprised me looking at the macroeconomy is that we had the shutdown that happened and then was longer than expected, which is a negative for GDP. And then we had an inflation report, which was much better than everybody expected, why 48 people at Bloomberg missed it on the high side. And so I'm thinking if I'm sitting at the FOMC thinking about how that affects my decision at the next meeting, then I'd say I'm more likely to move because we got like two things that say, oh, well, the only news we have is more likely to move. And then somehow, Jay decided that the news between the two meetings made him less likely to move. And that's an example of a policy disagreement I have.
And that was U.S. National Economic Council Director Kevin Hassett speaking with Carlyle co-founder and co-chairman David Rubenstein. You can watch more of that interview on the David Rubenstein Show on Bloomberg Television this Wednesday, 9 p.m. in Hong Kong, 7 p.m. in actually, it's 9 p.m. in New York, 7 p.m. in Hong Kong. That's happening on Thursday. Now, let's get perspective from Fiona Yang, fund manager, Asia, ex-Japan equities at Invesco. Invesco is one of the global asset manager with $2.1 trillion in assets under management as of September 30th, 2025. Fiona, good to have you with us. So, likely to be Hassett, we don't know for sure, but likely to be Hassett at the Fed, and that possibly means lower rates. It essentially also means that Asian stocks to be well supported.
I do agree with that view. I think the market is already pricing in quite a high chance of a December Fed rate cut. And what it really means for Asia is that for countries such as India and Indonesia, they would just have a lot more room to loosen their monetary policy and further stimulate economic growth. So I was actually in Jakarta last week meeting with some of the policymakers, and their tone is pretty upbeat. The new finance minister is trying to inject liquidity into the economy through the banks, and they're also putting money into the pockets of consumers to spark consumption. Without Fed interest rate cut, I think it will be extremely difficult for countries like Indonesia and India to really go on that path. So definitely music to ears for Asia investor like myself.
So given the optimism for the Asian markets, would you be anticipating more outflows from the U.S. into this part of the world?
I think there are a few elements in place that's supporting the continued diversification of assets. The U.S. dollar weakness is one of them, as well as the interest rate cut that we discussed just now. And then there are also fundamentals that in Asia really support the structural growth of the economy, as well as the market performance. Looking at this young and growing population, very innovative, and at the same time, Asia continue to be the manufacturing powerhouse of the globe. And I just think there are so many companies to really choose from for stock pickers like myself.
So you talked about Indonesia, and you talked about how India would also be benefiting from perhaps the diversification and the growth in this part of the world. But I'm not hearing Korea. Is it because of the massive run we've had in Korea so far?
So Korea is an interesting place, definitely to look at. I think it has ridden the wave of value-up initiatives, just like what has happened in Japan. And this is a market, if you ask me 18 months ago, I was banging on the table and telling my investors, as well as my colleagues, please buy Korea. There are just so many things working in this country's favor. There's a cyclical upturn in the memory cycle going to come, which is supported by this AI adoption around the globe, and at the same time, the value-up initiative driven top-down by the policymaker is just a game changer, because Korea used to trade at a very hefty so-called Korean discount because of poor perceived corporate governance. But what I have observed over the past 18 months is really companies in my portfolio trying to increase total shareholder return through both buyback as well as a higher dividend payout to reward shareholders like myself. So all of this just attract more money to flow into Korea. So where we are from this point on, that's your question. So going into 2026, I would say I would tone down my optimism by attack, because a lot of this positive outcome on memory cycle is already pricing in the market. You really need to see some some wide adoption by AI, not just in the retail space, but also on the enterprise level to continue to drive that market.
But isn't it true that for Korea, it has gone beyond semiconductors? It's broadened already, and hence there's further upside for the market. I mean, there's potential for other sectors to be driving the growth in the market.
I do agree with that view, and it's something that I try to express in my portfolio. So the recent activities in the portfolio would be trimming some of the memory stocks because of that cycle has run really well. Probably there's still upside, so I'm not really selling all of them, but then at the same time try to diversify into a broad range of sectors. So one of the areas that I'm extremely excited about is the auto space. There was uncertainty with regard to the tariff that US will impose on Korean automakers, but reality, Korea has got a pretty favorable auto deal, trade deal in general, and lowered the auto tariff to 15% on par with all the other countries. So now Korean automakers with their very solid product pipeline to go into the US market, I just think there is a huge runway for them to further re-rate from this point.
And recently we've seen some money being taken off the table from Korea as well as Taiwan. Is that just about profit taking, or is that a reassessment of where money should be deployed?
So I do invest a lot of companies in Taiwan and Korea, and met many of them at a conference in Singapore recently. I think their overarching enthusiasm about the outlook is there. But again, just on AI, just on the global markets, investors are getting a bit tired with this CapEx party and start to ask, so when will AI be really widely adopted? So I think it would take time, just like cloud. It was a technology introduced 10 years ago, and it takes 3 to 4 years really to be widely adopted. And this is a faith that I have with AI capability. A lot of the companies are just waiting for the appropriate time to adopt that.
And it's hard to play the AI space without putting your money in China. Just yesterday, we saw DeepSeek, revealing 2 new models which are cheaper and more effective, perhaps, than NVIDIA. I'm just curious what you think about, the AI space in China. How much more upside is there?
I'm extremely excited about the AI capability in China. DeepSeek is actually, the DeepSeek moment happened earlier this year, right? It really wake up all the investors and take China seriously in the AI race. I think China has great backbone to support the AI development from this point on. The electricity is extremely cheap, and grid has been upgraded over the past decades to one of the best globally. And also, there's mountains of data to be used to fuel this AI race. Admittedly, there is chip constraint, but from the recent conversation that we have with the companies onshore is really they're trying hard to source domestically, and there might be a little bit in terms of the technology gap, but then again the pricing for the domestic chip is really is at a huge discount as compared to what they can get globally. So there's a capex cost saving for the Chinese enterprises.
The AI play is increasingly getting complicated. People are questioning about where best to deploy capital. You talk about how supply chain is the way to go. Explain to us why that is so, and where exactly are you looking at these supply chains?
All right, great. So the disclaimer out there is because I run an Asia fund, so I can't really directly invest in the Mac 7. So
Would you otherwise?
In my PA, maybe. But in my portfolio, I express it through investing in the AI supply chain based in Taiwan, based in Korea, as well as the AI direct play in China. So on the supply chain, again, I just think they are trading at a discount to a lot of the global AI leaders. This is like getting the VIP tickets without paying the hefty price. So again, Asia is just a market that offers value as well as opportunity, a great place to pick some of the global trend.
The equity market is driven by sentiment. If you take a look at China, there's a lot of expectations of stimulus to prop up the economy. And, traders tend to be very impatient when it comes to waiting for that rate cut from China. And I'm sure that could be a risk to the sentiment, to the buying that we're seeing in China right now.
Yeah, so China is always, like any market, China is driven by sentiment, how investors really perceive the market outlook. But again, as fundamental long-term stock pickers, we try to really take opportunities in this market sentiment. When everyone is greedy, we try to be fearful. When everyone is fearful, we try to be greedy. So for my fund, we become overweight in China equities about 2 years ago when everyone else was fairly fearful. Market valuation was screaming, please buy us. And I'm really glad we listened. And in my recent trip to China, actually, there's still a lot of optimism to be observed, especially looking at the innovation on display. So I took my board of directors to China at the beginning of November. We saw a lot of amazing products like EV cars selling at a fraction of the cost as here in Singapore, and some of the medical equipment companies are really innovating, spend decades on R&D, and now they are becoming global leaders, not just China leaders. So those are all exciting places for us to invest in.
Can that optimism counter the risks out there? And we've yet to see a trade deal between the US and China, and we're seeing tensions between China and Japan. And we heard from the Taiwan's foreign minister now saying that perhaps it'll be at least a year before they resolve the issue. Lots of geopolitical tensions. How do you price that into your investments?
That's a great question, and those are the things kept me awake at night, not just my two toddlers. I would say we do pay a lot of attention to all this geopolitical risk, but at the same time, for us, it's more of a bottom-up stock picking. We try to avoid selective parts of the market that might be very sensitive to the trade policies as well as the geopolitical tensions. That's how we express ourselves, because preservation of capital is a priority for us to safeguard our investors' money.
Okay, looking at 2026, this Goldilocks Asian story will persist, and what are the conviction calls for you?
I think there are a few places that I'm extremely excited about. The first one is Southeast Asian market. I think this year, generally speaking, it hasn't done amazingly well as compared to other pockets of the market.
So it's a catch-up play.
I was just saying Indonesia, again, it's about the rate cut environment will help them to stimulate the economy and shift gear towards growth. And that will just help the equity market for sure. And then another hidden gem in Asia, I think, is the China consumer space. A lot of concern about deflation in that environment. Lower housing prices, would people be hesitant to spend? But reality is, in Shanghai, in November, I just saw tons of people on the street. They're happy to spend. It's just their consumption pattern has changed. The things they value are different.
But
from
Shanghai
what they
is
did
not
in the
China.
past. I think it's quite representative of China. There are a lot of young people on the streets, a lot of tourists that coming from other parts of China as well as globally. So it's a dynamic place, definitely one of the leading places that if their consumption pattern shifts towards a certain category of products, the rest of China will probably follow.
Fiona, great insights. Thank you for joining us. Fiona Yang, Fund Manager, Asia ex-Japan Equities at Invesco. Coming up, Amazon's cloud unit releases its latest AI chip called Trainium 3 to take on NVIDIA and Google. More details coming up next. Keep it here with us. This is Bloomberg. Inside, Amazon's cloud unit has raced to launch the latest version of its AI chip as the company renews efforts to sell hardware capable of rivaling products from NVIDIA and Google. On the sidelines of Amazon's reInvent conference in Las Vegas, AWS CEO Matt Garman spoke to Bloomberg about the new accelerator called Trainium 3.
The desire and the hunger out there for more power and more compute is almost insatiable. And so the more we can take an existing power footprint, an existing set of capabilities, and bring more and more compute into that for customers to build cool applications and cool environments and to get value from that, that's what we're focused on. And so we're going to be pushing that envelope as fast as we possibly can to get those new capabilities out to customers.
The pitch for Trainium in both the training and inference use case is that it's a great deal. Cost effective, performant. Yeah. At the same time, you went on stage and said AWS is, quote, by far the best place to run NVIDIA GPUs.
Yeah.
How are both possible?
Well, both are possible because that is a great environment to run accelerators and compute in. And so we've been working for 15 plus years with the NVIDIA team and Jensen and team to deliver outstanding capabilities for our customers. And for when you're running a large cluster of NVIDIA GPUs, people will tell you AWS is the best place. You get the best performance, the most stable cluster, the best capabilities out there, and broad scale. And that's why folks like OpenAI and others are running on AWS. And we have that choice. And so for others that want to be able to take advantage of Trainium, and there's some use cases that are best for Trainium, there's other use cases where NVIDIA GPUs are going to be your best option. We want to have all of those available. And so we think that if we can continue to push the envelope on what Trainium can deliver for customers and make sure that we are supporting the latest and greatest from everything that the awesome team at NVIDIA is delivering, that's going to be the best outcome for our customers.
The plan for AWS is to basically double capacity by end of 2027 to around 8 gigawatts. Do you have a sense of how you apportion that capacity in-house silicon and server designs of Trainium versus NVIDIA GPUs?
We're just going to keep pushing as fast as we can, and we'll see where customer demands drives us as we go. And as you said, we're massively adding capacity. In the last year alone, we've added 3.8 gigawatts of capacity, and we'll continue to add more and more over the next couple of years. And we'll let customer demand drive us a little bit on what they're looking for and what they want. And that's what we always listen to, and that's what we'll continue to listen to.
The focus with Trainium in the time I've been able to interact with you and talk about, not just the accelerator, but at the server design level, there's a lot of benefit to the customer. When does that benefit start accruing to AWS in terms of profitability? Like if it's such a good financial proposition, you must be able soon to say we're making a lot of money on this.
Yeah, well, you're already seeing some of the benefits accrue. You see things like Bedrock growing really, really rapidly, and you see Trainium powering that under the covers. And we announced today that more than half of all tokens and inference done in Bedrock are done on Trainium 2 servers under the covers. And so you're already seeing that benefit come. You see the models that we're building in Nova and Nova 2 start to get better and better over time and be accelerated by Trainium. And so we really think that there's a whole bunch of dimensions on which both our customers, our partners, and our own products are going to get accelerated, all from Trainium.
Every time you come onto the program, I always offer the audience opportunity to pose a question to you.
Yeah.
There's a lot of interest in AWS, right? Many of your customers span global technology. Actually, most of the questions were about Anthropic. That wasn't much said on stage. I think people are trying to understand what is the benefit and advantage AWS offers to Anthropic while they are ramping Trainium through Project Rainier, but also ramping their TPU allocations as well.
Yeah. Well, our partners at Anthropic, our partnership with them is incredibly strong, and it's never been stronger. And we do a ton of collaboration with them. And as I mentioned, through Project Rainier, it's a huge collaboration there to go build their current generation models. And all their models run today and launch on day one on top of Trainium and on top of AWS.
And UltraGreen.ai popped on its trading debut with shares jumping as much as 12% today. The company raised $400 million in its IPO, the biggest in Singapore since 2017, outside of real estate trusts. UltraGreen makes fluorescence technology used in surgical imaging. Now coming up, Italy's export credit agency, SACE, says its outlook for trade and investment trends. More details just ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, and here's a quick look at where markets stand as China heads to lunch break and Japan comes back online. Asian markets are trading within tight ranges this Wednesday as investors await fresh catalysts. Meanwhile, we're also tracking a rebound in cryptocurrencies after Bitcoin surged back above $90,000 in the previous session. We're also keeping an eye on the Indian rupee. It hit a fresh record low of 89.95 on Tuesday, inching closer to the key 90 per dollar level. Also, one to watch, silver hitting a record on rate cut bets as well as very tight supply. Commodities have been on a tear of late. Now, speaking of commodities, oil in focus today. As traders keep an eye on Ukraine peace talks, the Kremlin says President Putin held very useful talks with U.S. envoy Steve Witkoff and Jared Kushner, though they failed to agree on a plan to end Russia's war. For more on this, let's bring in Bloomberg's John Haskovich. John, how much progress was actually made? I mean, some say perhaps not very much.
Exactly. We had some positive spin on this, that the talks were useful, but the actual progress just isn't there. We're seeing two things happening. One is the diplomacy is speeding up with more and more of these high-level envoys speaking with Russia and also speaking to Ukraine. But the actual demands, what Russia is looking for and what Ukraine are looking for, still are far apart. Putin is making maximalist demands in terms of territory, limiting the size of Ukraine's military, and calling on Kyiv to abandon any hopes of joining NATO. For Ukraine, they see these as too much. They've rejected a lot of these points, and they are looking for security guarantees coming out of this. So the talks are going on. The two sides are not really making much progress. And it seems that there's an impasse that's going on while the diplomacy is speeding up.
And John, why is Putin considering to strike ships surrounding Ukraine?
What we've seen in the past few days or past week or so is Ukraine has stepped up its attacks on Russia's shadow fleet. These are tankers that carry Russian oil to parts of the world in a way to avoid sanctions and hits economically. Ukraine has been conducting a campaign over the past several months of targeting Russia's energy infrastructure, trying to go after the force that drives the economy, that provides money for Putin. And Putin has seen these attacks on ships as escalatory. And he has said that Russia is considering going after ships that help Ukraine and also increasing attacks on Ukraine's ports and infrastructures in a way to retaliate for what has gone on with the shadow fleet. So this is, So Russia is doing a little bit of saber rattling while the talks have been going over the past few days with Russia, U.S., and Ukraine. Russia has really stepped up its attacks of missiles and drones in Ukraine and Ukrainian cities. So we see these things on the ground while the peace talks are going on.
John, thank you so much for that. Bloomberg's John Haskovich. Now, as peace talks with Russia continue, President Trump is also focusing on rising tensions around Taiwan. The president has signed into law a measure forcing the U.S. State Department to regularly review guidelines around the country's engagement with Taiwan. Republican Representative Ann Wagner, who sponsored the bill, says the new law sends a message to China that the U.S. stands strong against Beijing's efforts to dominate the region. We also heard from Taiwan's Foreign Minister Lin Qiaolong, who says China is a decisive enabler of Moscow. Lin spoke with us exclusively from Taipei on opportunities for closer ties with Europe, given their common security interests.
Now, European countries are facing the threat from Russia, with China being the decisive enabler behind the war.
Decisive enabler.
Yes. And now we have a common interest in terms of security.
Our interview with Taiwan's foreign minister drew a sharp response from China's Ministry of Foreign Affairs when spokesperson Lin Qian was asked about it during a daily briefing.
The DPP, Taiwan's Democratic Progressive Party authorities, harbour malicious intentions which are contemptible. Their attempts to seek independence by relying on foreign forces are doomed to fail.
This also comes as China is seeking diplomatic support from the likes of France in its dispute with Japan over Taiwan. French President Emmanuel Macron is heading to China for high-stakes talks with President Xi Jinping starting Thursday. Other issues on Macron's agenda include pushing Xi to use his influence on Vladimir Putin to end the war in Ukraine, as well as managing trade tensions with the EU. And just some breaking news right here. The Indian rupee weakening past that closely watched level of 90 per dollar. The Indian currency has been under tremendous pressure, prompting questions on whether or not the RBI will intervene to support the currency. Again, the Indian rupee weakening past that closely watched 90 per dollar level. Well, our next guest served as a politician and was Italy's Deputy Minister of Foreign Affairs. Guglielmo Picchi is now chairman of SACE, Italy's export credit agency, which helps companies grow their trade and investment opportunities in domestic as well as international markets. Mr. Picchi, good to have you with us. First off, let's start with Ukraine. Given your experience in foreign affairs, we've had, of course, Russia saying that Europe should be held responsible for the deadlock, blaming Europe for sabotaging the peace plan. What's your take on that?
Well, if you want to have, some sort of truce or, starting the peace, it's not that you can do it without the Europeans. So the Europeans have to be involved in the process. The outcome of the talks, I said that we support the initiative of President Trump. Some points are, debatable, but it's a good basis to start. Also, Ukraine said that it's, a go-ahead, the Trump's plan. It seems like on the other side there is not really a willingness to negotiate. The point on Putin's side is really to gain as much territory as possible in the next few weeks to have a better negotiating point. So the blame is not really on the European. The Europeans are not really escalating. It's really on Putin playing the usual game and not really wanting to start this talk.
Is Europe on its own in trying to defend Kyiv's interests? Because we've had both the US and Russia trying to carve out the territory, and some say it is being carved out in their own interests.
Well, I would say that, of course, there is a change of posture from the US towards Europe, but Trump is a deal maker. He knows very well that trade drives the relationship. It's very transactional, this approach. Well, I remind to Trump that the exchange between, the commercial exchange between Europe, not just the EU, the broader Europe and the US, is so strong that there's no force whatsoever that will drive away our traditional alliance. So I don't see the Europeans being left on their own. What I see is still Europeans not being enough proactive in this discussion, in these peace talks, and not using all the leverage that they have, the economic power that the European Union and Britain, never forget that, although outside the EU, is part of Europe. So I would say that Europeans should use a little bit more diplomacy, and they're failing to use the tool that they have in their hands.
But is the EU united in the first place in trying to push the interests of Ukraine? I mean, can it steamroll the likes of Hungary and Belgium, which resist one way or another?
Well, there is the EU is a complex machine. Of course, the EU doesn't have a united foreign policy. But the likes of Germany, France, Italy itself are the driving force of the EU. So once you have, the big three on boards, then the others follow. Of course, there are carve-outs. You cannot force a sovereign state like Belgium who has the assets, to use them, because it's still a very debatable point. And you cannot ask Hungary that the only pipe that brings energy into the country comes from Russia. So either you understand that Orban switches off his country for what? There is not an alternative plan. What it seems not to be a unity is, very specific cases that are very understandable. The Trump administration understood them well. And sometimes there is an ill-fated judgment in some parts of the bureaucracy in the European Union that derails from, the true reality on the ground. The European Union passed all at the unanimity, always all the sanctions, all the efforts towards Ukraine. Something different is taking big steps like, the military support and other stuff. On this, of course, each country is sovereign. Defense is not in the competence of the European Commission, it's at the member states level. So, for instance, Italy has a different stance from France. Germany is at a different stance as well. So, yes, there is some disunity, but so far the course of action has been very united. But diplomacy at European level has to kick in with much more strong power.
Are you convinced, are you confident that there can be a fair peace deal for Ukraine?
Not in the short term. I don't see it coming very soon. But I understand that what is happening, Putin claiming, the escalation, it seems that all the energy, attacks on energy that very successful Ukrainians are doing are having, are biting, and that's something that sooner or later will take Putin to the table. Also, for how much you disregard human life, losses on the battlefield are high, and you cannot sustain indefinitely a war effort. So the problems are also on the Russian side, and sooner or later also the Russian has to come to more, much more effort to find and get to a stable peace agreement.
Emmanuel Macron due in China on Thursday, both for trade as well as Ukraine. And we had Taiwan Foreign Minister talking about how China is an enabler in Ukraine. What's your take on the role China can play? Is China an enabler? And will China play its part to dial down the tension?
Well, China, it's a member of the Security Council of the UN. They have veto power. They have, they are a superpower. So as any superpower, there is always, if they're willing to play a role, there is a role for them to play. I would say that if they, they can be effective in, shaping the mind of the Russian leadership to enter a peace. So yes, it's an enabler, both for not having peace or for having peace. So it's a decisive actor. So I see with interest what Macron will get out of his trip to China, although so far he has been very ineffective. We've seen the many attempts that he had done with Putin. So I'm not expecting, but let's say positive, and see if the diplomatic effort from Mr. Macron produce any result.
China, of course, a very important market for you, the biggest trading partner in Asia. How do you view the Chinese market right now, given the slowdown in its economy and data suggesting that it is still pretty lackluster in terms of growth?
Well, yes, we see with attention. Fortunately for us, yes, it's the largest market in Asia, but it's not a decisive market within our export. So it's just a fraction of our 650 billion of export. So we are not very afraid, and we see that with a growing middle class, for our kind of export, the future is bright, so we are not very afraid. We understand the slowdown in the economy, but for our kind of exports, I don't see a real negative impact. There are just opportunities. I said it's tiny what we are doing with China, so if we're pushing that direction, there is really scope for great improvement and to make our export
Are you concerned about China's overcapacity, China's dumping cheap products, while at the same time it is climbing the value chain, which means it is actually competing with the likes of Italy?
Yeah, of course, we see them as competitors, but there are many products that are, that we are not really, on the same level of competition. So although we might, feel and have a negative impact from some sort of products, There are, a bandwidth of other products that, are very high-end, where margins are very high, where there's basically no competition whatsoever in not just the traditional luxury goods that is, something easy to but on many other products, I would say that Italy is still very competitive and can increase what is a very low market share and low volume of export. If you consider that, we export 70 billion to the US and it's a mere 15 billion to China, so there is 55 billion to grow. So we are, of course, we see with attention what is going on there, but we are not afraid of the slowdown.
Of course, the exports to the US at risk because of the 15% tariffs being imposed. Can that be compensated by maybe your exports to this part of the world?
Well, this the Southeast Asia, it's our, of course, we have offices here in India, Singapore, Vietnam. So for us, it's a very important area to diversify our export. We see that there is, room for growth, and we will pursue this growth, and that's the reason why I am in my mission here, visiting clients and trying to understand the real opportunities that are on the ground for Italian corporates and to push our exports.
It is a balancing act, and as we said earlier, China is a very important market. Geopolitics come into play all the time when it comes to trade. What if China asks Italy for backing for its stance on Taiwan? I mean, what do you see Italy doing and responding?
Let's say that we are. Italy has, one big advantage that is within the EU and within NATO. So what are our alliances are pretty clear. So it's not that we are, drifting away from what our allies and discussion with our allies. So we see what China is claiming on Taiwan. We recently have Taiwan opening a second office in Milan. We have very good ties, and although the diplomatic ties are not there, but the trade is going well, and so I don't see following a foreign country telling us where to stand. I would say that the traditional approach of standing with Taiwan will stay in place.
As we look into 2026, what are the opportunities in this part of the world? How do you see supply chains being shifted as a result of the tariffs imposed by the US? And how are Italian companies navigating that and perhaps capitalizing on Asia?
Well, we see that there is a unique window of opportunity for Italians and for this part of the world to deal with Italians. We have, very good manufacturing that is very much needed in this part of the world for big projects. And we see something different, especially here in Singapore, that not only we can do business in this part of the world on, green transition, digitalization, infrastructure, biotech. So there is, really many fields we can cooperate, but we can also cooperate inter-countries, and I see the big interest of diversification, for instance, from Singapore towards Africa, where we have our piece of policy of the so-called Mate plan that is an on-par partnership to invest in Africa with our African friends. And with Singapore and with many others in the region, we can do many things there together. So I'm very positive on the fact that there is a window of opportunity that we need to secure and diversify the supply chain, and this part of the world is good both for our import and our exports.
Mr. Picchi, we thank you so much for your insights today. Guglielmo Picchi, chairman of SACE there. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Michael and Susan Dell have pledged to give 25 million American children $250 each to jumpstart an investment account for the future. The move builds on the Invest America initiative. The Dell CEO spoke to Bloomberg more about the philanthropic gift?
On July 4th, or I think 5th, actually, because the 4th is a holiday of next year, every parent will be able to claim the account for their child that's 18 and under. And originally, those accounts will be held in custody by a custody bank, and then eventually you'll be able to choose your bank or your brokerage that holds the account for you, and it's the property of the child.
What banks, what asset managers have you been talking to? How do you think, from an infrastructure perspective, this would work, Michael?
Right. I have not been having the conversations with the banks. I actually, a number of them have told me that they're interested in being the banks to hold these accounts. I think it'll be, all the major banks, and, the parents will be able to choose whichever their favorite bank or, stock brokerage is.
What's so interesting is this has bipartisan support, as we understand, from letters being written just yesterday, asking Cory Booker as well as Ted Cruz, asking those to come alongside you, for corporates to invest alongside.
That's right. I spoke with Senator Booker last night about this. I spoke with Senator Cruz about this earlier today. And there is completely bipartisan support for this idea. It's not a political initiative. This is about investing in children, and we think that's the smartest investment that we can make.
Michael, why do you think it wasn't picked up earlier than this? Since 2021, shout out to Brad Gerstner, is almost his idea, this initiative. Why did it take this administration this time?
Well, it's a great question. Brad did tell me about this in 2021. We talked to the prior administration about it. I think it's hard to get legislative action like this done, but now it's the law. And so here we are. And so we have a great opportunity for the future to build on this platform.
Dell CEO Michael Dell speaking with Bloomberg's Caroline Hyde. And here are some other stories we're following. Bloomberg has learned that Comcast is looking to merge its NBC Universal division with Warner Brothers Discovery after making a renewed offer for part of the company. Sources say Comcast aims to create a larger entertainment entity by combining the NBC TV network, its film and TV studios, and theme parks with Warner Brothers. Bloomberg has learned that OpenAI CEO Sam Altman is shifting resources to accelerate ChatGPT improvements, pausing work on autonomous AI agents in advertising. Sources say Altman urged staff to prioritize ChatGPT amid rising competition. The information also reported that Altman warned employees Google's AI resurgence could create temporary economic headwinds for OpenAI. And coming up in the next hour, we'll speak exclusively with BSE CEO Sundararaman Ramamurthy on the outlook for Indian markets as a challenging year for stocks draws to a close. Plus, QCP Group CEO Melvin Deng will be joining us to discuss Bitcoin's latest big swings and the outlook for cryptos from here. More to come in our next hour of insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Here's a look at how Indian markets are trading about 15 minutes into the open. The rupee has fallen past a key psychological level of 90 per dollar as delays in finalizing a trade deal with the U.S. continues to dent sentiment. The rupee, by the way, and the broader Indian markets have underperformed as traders await a trade deal with the U.S. to lower some of the harshest tariff levels in Asia. India is one of the last major economies yet to sign a deal with Washington, even as officials have repeatedly expressed optimism one will come soon. Well, for more on the rupee's weakness, Bloomberg's FX and rate reporter Malavika Kaur-Markle joins us from Mumbai. It does seem like the currency continues to be under a lot of pressure, Malavika.
Yes, that's right. And as you rightly pointed out, the rupee has been on a free fall since the past few days. And the main factors weighing on the currency is the fact that, we have such high tariff rates on India at the moment from the US. I mean, 50% has to be one of the harshest levels in Asia. And the fact that we don't have a trade deal yet with the US is all weighing on the currency. We also saw our trade deficit widen. And despite the GDP blowout, you do feel like markets are starting to believe that the RBI will have to hold rates on December 5th when they meet for their rate decision because of the currency angle, because the rupee just crossed that 90 psychological level.
The question really is how much appetite. The RBI has said time and time again that it is in no hurry to support the currency.
Yeah. I mean, the RBI is stepping in. They have stepped in, but we also have seen a change in policy. Like you rightly said, they've gotten a lot more hands-off than was the case under the previous governor. Though I do have to point out that this is a very big level. It's a key psychological level. So you do expect the RBI to intervene, to sell dollars to support the rupee because, like we saw last month, they intervened quite forcefully to snuff out what they saw to be speculative bets against the currency. And analysts that I've spoken to, they have also mentioned to me that, there is no fundamental basis for the rupee to be as weak as it is. It is just the fact that, there is some speculative bets against the currency which is driving this weakness, given the fact that we still don't have a trade deal, given the fact that we're facing such a high tariff rate.
I guess the question is, fundamentally, how can the rupee go higher from here? How can it be supported?
Yeah, it can be supported if we get a trade deal with the US because, I mean, we were supposed to be one of the first countries to get it. But here we are still a couple of months later. We've seen everybody else in the region get, better tariff rates, get into trade deals. We've seen frameworks come out. But with India, it's always been kind of on the fence, will they, won't they? But yes, that is the main factor. And as Barclays also pointed this out, that we can see some respite in the currency if there is indeed a trade deal that comes in. Also, it hasn't helped the fact that we've seen such massive outflows from the equity markets this year. We're on course to seeing an outflow of roughly about $16 billion. Yeah.
Malavika, thank you so much for that. Bloomberg's FX and rate reporter Malavika Kaur McCall there. We have breaking news from HSBC. It is appointing Brendan Nelson as the group chair to replace Mark Tucker. Brendan Nelson has been named as the group chair, who will be taking over from Mark Tucker. Tucker made the surprise announcement in May that he was stepping down. He's slated to become the non-executive chairman of AIA. Well, India's IPO market now, it's been one of the busiest in the world this year with strong domestic demand for debuts including Tata Capital, LG Electronics India and Lenskart. But regulators are now slowing the pace of approvals as the Securities and Exchange Board demands more granular disclosures. For more details, let's bring in Bloomberg's managing editor for Asia Equities, Lienting Tu. Lienting, why is there such a delay in regulatory approvals?
Yeah, it's surging demand met with the delaying or slowing approval. That's quite a conundrum. The reason really is there's just a huge number of deals hitting the public market, and that's getting too much for SEBI to process in a timely fashion. So this year alone, we're seeing almost 160 deals being filed, and SEBI took about 117 days on average to process these deals, and that deal volume compared with 110 last year and just 30 about a decade ago. So you can see SEBI is basically scrambling to scrutinize each deal, and that is really why the deals take much longer to process.
How's the Indian IPO pipeline looking for the remainder of the year?
Yeah, looking actually quite robust. We're seeing Micho, an e-commerce platform, opening books today for its $600 million IPO. And there's also ICICI Prudential, which is looking to raise $1.1 billion. So that would be probably the last $1 billion IPO in India this year. Overall, the deal volume is set to surpass the record that we saw last year, which was $21 billion. But overall, I would say momentum is losing a little bit on the demand side. We see 40% of IPOs this year are now trading underwater, and about a dozen companies actually chose to delay their IPO plans even after they received SEBI approval. So not all rosy out there.
Cautious is the word. Lian Ting, thank you so much for that. Bloomberg's managing editor for Asia Equities. Lian Ting, too, well, joining us exclusively. Sundararaman Ramamurthy, managing director and CEO of BSE, Asia's oldest stock exchange. Ramamurthy, thank you so much for joining us. We talked about the IPO market. How much conviction is there that you can build on the momentum for 2026?
See, the IPO market is just one indication. It is how the country is resilient and what are the basic fundamental growth factors in the country is what should be looked at. If you look at it from that perspective, the GDP growth rate that we are seeing in India, the demography of the population, the average age, the median age of the country, that growing demand within the country, and the capability for the locals to earn a living in the sense that 65% of the population is in earning age. These are fundamental factors which I feel is going to make India continue to remain strong. A trade deal can come and go away, things come and then things become different and things become better. What is most important is fundamentally how strong the economy is. Under the leadership of the current government, I think the country has been very good. The IPO market, if you look at it, the number of increasing IPOs that you are seeing that coming into the market is one another testimony to the faith that the people have in the economy.
But SEBI is intensifying its scrutiny. Is there reason to, I guess, be concerned about the quality of these IPOs? We heard from my colleague just slightly earlier, about 40% of those IPOs are trading underwater.
The price at which any market, any stock will trade is a function of multiple things. It is about the economy, about the alternatives available, and what is the status of the market at that point of time and the market sentiments at that point of time. Therefore, I don't think that if the stock is trading at a lesser price after IPO, that indicates anything wrong about the quality. Regulators in India have always been very cautious about the scrutiny levels of any IPO that passes through them, and they've always tried their best to give the best of IPOs fully compliant to the market so that the public stand benefited.
So what's the outlook for 2026 in terms of the IPO market? I mean, what kind of values are you looking at? How many are you looking at? And might the fact that SEBI is, deepening its scrutiny impact the number of IPOs for next year?
See, the last year was a record year for India. In terms of the number of IPOs, I think we were the largest in the world. In terms of value of IPOs, we were the second largest next to US. This year, the trend, if you look at it, we are following the same trend and we have been doing wonderfully well. I think 2026 will equally be the same. I will not say that the delay is because of any deepened scrutiny and therefore it is happening. There are multiple IPOs that are coming and naturally and necessarily therefore the process...
Is there a number that you can share with us in terms of how many IPOs can be expected?
I wish I had a crystal ball to tell you how many more IPOs will be coming. What I am seeing is there are quite a number of IPOs which are already in the pipeline at various levels of the numbers which you saw in your own screen few minutes before, which are at various stages of approval. I think the market per se to me looks very good and has fundamental strength. There will be temporary and smaller issues which come repeatedly. In any market it happens. There could be some concerns interim, whether it is a trade deal, whether it is a volatility or whatever it is. But fundamental strength is unquestionable for Indian markets, is what I feel.
Might too much money be flowing into the IPO market? Is there reason to think that it could be too hot, that it becomes a risk?
if you look at the number of participants in the market, if you look at the percentage of Indian population who are trading in the markets, if you look at the percentage of domestic household savings that are getting to the financial sector, I think the room is very, very, very large in India. And in terms of more money flowing into the IPO market, there are no great other viable alternatives that are available. In India, you don't have cryptos. What you will do is mainly you will trade gold or real estate or stock market to some extent, and to a greater extent mutual fund. If you look at the mutual fund market, huge amount of money is flowing into the market. If I use an Indian number, 30,000 crores is what we say. I'm sure you understand crores and lakhs. 30,000 crores is the SIP that flows into the Indian mutual funds on a monthly basis. With so much of money coming into the mutual funds, naturally the deployment in the IPO market is also very high. So the more and more of financial saving getting converted into domestic savings getting converted into financial assets is one of the reasons for this happening. And still, we have not even scratched the surface. There is much more to happen. The growth is happening in a big way in beyond 30 cities. I feel much more is to come.
Yet, no conviction among foreign investors. They've been pulling money out of the Indian market. Never mind 8% growth, never mind demographic dividends. They're not in India. Why is that?
See, is it that only the foreign investors are pulling money this year? It happens every year. Typically during December, more money gets pulled out because people want to book their profits and show to their bosses what is the amount of money made in any country. That is one part. And second, a global investor is not trading only in India. He is trading multiple markets. There will always be certain changes in every economy across the globe, which may make that particular economy attractive for that point of time. This year, if you look at it, Japan has been attractive. Korea has been attractive for various reasons. AI is stated as one of the reasons for attractiveness of some of the markets. So naturally and necessarily, global investors will like to get into that market which gives them at that point of time a greater return. That I don't think stands as a testimony to the fundamental strength of an economy.
But foreign investors have been pulling out of India not just in the last 2 months or so. They've been pulling money out for some time now.
If you look at it, despite that, the market has remained resilient. And earlier on, 10 years before, if foreign investors have been pulling money, the market would have tanked. Not today. That very clearly indicates the strength of India, the strength of the domestic institutions. I don't think foreign investors are questioning that. Foreign investors will go to that place, which is a greener pasture at that point of time. It's a very normal and regular phenomenon.
It's been a year since the curbs were imposed on the derivatives market. What impact has that been on the business?
I will not agree with you on the word curb. I will call it as a rationalization on derivatives market. Because any market which is evolving, look at it this way. The regulators in India were born only in 1992. Across the globe, the regulators were born much before. So in a short span of time, the regulators in India have not only to catch up, they have to become better as well, as a late mover advantage. So you'll find the pace of regulatory changes in India always more, which is not because of anything that is to do with the regulator. It is because there is a big catch-up requirement there. So when a market which is introduced just 25 years before, derivatives got introduced only in the year 2000, when it is growing fast, the regulators also have to think fast and they have to rationalize. The rationalization as far as BSE is concerned has been a big boon. BSE just started its derivatives market meaningfully only around 28-30 months before, and we are going extremely well. And every one of them.
What is extremely well? I mean, big boon. Can you quantify, like, what kind of growth?
Sure.
What are you seeing?
Sure. Though I generally don't talk in terms of market share, in terms of derivatives, I claim every product is unique, so it has a 100% market share. If you look at Sensex option, which got introduced in May 2023, today I am having, in terms of number of contracts, a market share of 48%. Have you ever seen any contract which in 28-30 months getting into this type of a market share? And my market share in terms of premium traded is hovering around 30-31%. So clearly that has been a big growth in the last 2.5 years for me. That clearly indicates that the rationalization which was brought has brought in level playing field, has ensured the emergence of good and alternate products in the market, and my volumes have not tanked because of any rationalization. The participants have increased, the number of FPAs coming in has increased, the demand for the co-location racks have increased. Today I am having around 400 plus FPIs trading with me, which used to be zero in May 2023, and today I have around 420 colo racks which has been distributed. I have around a participation of 2 million investors into the derivatives market, which is all picking up in a big way.
So you've benefited from the rationalization, or we call it cubs. And we know that SEBI is mulling further cubs, further rationalization, if you wish. Is it necessary? And what do you see SEBI doing in the end?
I'm not aware of, honestly, any further rationalization being talked about by the regulators. As you would know, in domestic media in India, there were a lot of rumors whether the regulators are unhappy about the weekly options and is there a probability of a ban of weekly options. Regulators have multiple times, and including the government multiple times, it has been clarified that the regulators are not interested in killing derivatives. That's not the idea. It is their wish that the monthly products and quarterly products do better, and what they could do to make them trade better. That is the thought process. And in India, fortunately, regulatory process is a co-created process. There will always be a consultation paper. Market participants will be consulted before any regulatory change. At this point of time as we speak, there are no consultation papers or no consultations happening on bringing in any further rationalizations or curbs into the derivatives market.
Mr. Ramamurthy, it's been a pleasure having you on Insight. Sundararaman Ramamurthy, MD and CEO at BSC. Well, Singapore is seeing a stock popping on debut after a successful IPO that, for a change, is not directly involved in property. UltraGreen.ai raised $400 million in its IPO, the biggest in Singapore since 2017, and that's apart from real estate trusts. UltraGreen makes fluorescence technology used in surgical imaging. Bloomberg data shows Singapore IPOs have already raised more than $1.5 billion this year, putting the market on track for its strongest showing since 2019. What a reversal of fortune for the Lion City. Now, still ahead this hour, the OpenAI boss declares code red as its ChatGPT product faces fresh challenges from the likes of Google and Anthropic. More on the escalating chatbot wars. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Bloomberg has learned that OpenAI CEO Sam Altman is demanding rapid improvements to ChatGPT, declaring a code red situation that will delay work on other initiatives. For more on this, let's bring in our tech reporter, Annabelle Drulers. Annabelle, code red means it is about intensifying competition among AI developers, isn't it?
Yeah, that's right. It really does seem like these recent events that we've seen, or developments from the likes of Alphabet with its Gemini model, really could have hit a nerve at the company. So this information, as you said, it hasn't been reported by OpenAI, but what we're hearing from sources that are very close to the situation is that CEO Sam Altman, he wants all hands on deck. That's what he's saying, and that's what he apparently said in a memo to staff. So, yes, there's this code red situation. It means essentially that people, staff at OpenAI, need to delay work on other initiatives. They need to, for instance, move away from tasks like agentic AI or rollout of AI-integrated advertising. The concern seems to be, and this is what's been reported by the information, not by us, but the concern is that resurgence of Alphabet, and we've seen, of course, a lot of interest on its Gemini model. We have the Gemini 3 model, for instance, just released a few weeks ago. It was immediately met with widespread praise. People were very impressed with its different capabilities, and that even came after OpenAI had also recently taken on Alphabet by releasing its first AI-powered web browser. But I do think it speaks to that bigger risk that we see in AI, and that's as AI technology, LLMs in particular, or foundation models become more and more commoditized. How do you set yourself apart from competitors? And how does a company like OpenAI continue to justify and fundraise at such a lofty valuation?
So the boss says all hands on deck. What's been the response from the staff?
Yeah, well, we didn't get a direct response from OpenAI to this reporting, but I do think that an X post from the person who's responsible for heading up developments of ChatGPT is quite telling. So Nick Turley, he posted on X late Monday night, and he said, and I'll just quote him, the focus now is to keep making ChatGPT more capable, continue growing, expand access around the world while making it feel even more intuitive and personal. And that's exactly what we're hearing has been the directive from the top down, so from Sam Altman across the staff. And that does include as well deploying more people to this effort. So we're hearing, for instance, that staff or employees that aren't even involved in ChatGPT directly are being asked to join ChatGPT team calls. And the Wall Street Journal also has a report out saying that Sam Altman is encouraging temporary transfers, and he himself as well as taking part in these daily teleconferences with the ChatGPT team.
Belle, apart from Alphabet, which other companies, are they looking out for?
Yeah, I think a really notable one as well is Anthropic, and they, of course, have the Claude model. But Anthropic was founded by ex-OpenAI employees just a few years ago. It's smaller, but it has had a lot more success, or it is having quite significant success with enterprise customers in particular, and this is a key path toward monetization for these companies. So they just recently launched their latest version of that Claude AI model, and it's seemed to be better at automating coding, office tasks as well. So again, that competitive space there. But we have seen as well, and we were talking about it this week, the progress we're seeing from the Chinese companies. So we had DeepSeek, for instance, rolling out 2 new iterations of its V3.2 model, and also that the standard one plus the Special that's better at sort of longer form mathematical computations. But there's also what we're seeing from Alibaba, for instance, with its Quen portfolio, and again, reintroducing that to a consumer market. So a very, very competitive space, especially not just in the US, but as companies as well look to grow their international audience.
Belle, thank you so much for that. Bloomberg Tech reporter Annabelle Drew is there. Still to come on Insight, Bitcoin bulls recovering from a bruising sell-off as the dominant cryptocurrency surges back above $90,000. An update next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on cryptocurrencies after some wild swings in the market in recent days. Bitcoin in focus today after surging back above $90,000. For more, let's bring in our cryptocurrency reporter, Subhashri Ghosh. Well, it's far from a turnaround, right? It has recovered, but not really a turnaround. Is that conviction?
Indeed, you're right. I mean, it looks like there is a slight bit of bounce back, but as you can see that, the conviction is lacking because we don't have a ton of buyers on the top side as of now, as we speak. We can see, the large chunk of buyers, typically of crypto, especially Bitcoin and ETH and the top currencies, cryptocurrencies, are more or less absent, like the digital asset treasuries, the demand from the digital asset treasury buyers, the ETF players. I mean, that kind of institutional demand is quite lacking. And that's the reason that we are seeing, the shaky recovery, not like a very conviction-based recovery yet. Otherwise, we would have seen a large upside already by now. And the other part, as I would like to mention, is there is an index called Fear and Greed Index in crypto. Yesterday it was 23, which was extreme fear. Now, given this slight momentum, we are seeing it at 27, which is still at fear. And that signals the momentum is still pretty, fragile as of now. Traders are sitting on stable coins, which is, again, another crypto liquid cash, waiting for, some kind of positive trigger, but they're still reluctant to commit. So
all right, Subhashri, stay with us. Let's bring in our next guest who runs one of the largest institutional digital asset firms in Asia. Melvin Deng, CEO of QCP Group, is here with us as well. Melvin, I mean, what is this? Spring cleaning, housekeeping, or is this, structural fragility?
Yeah, I think it's a very good question. But when you look at the overall macro environment, I think we've seen a bit of a vol shock coming through all asset classes. And I think this rinse is generally quite positive for risk formation. If you looked at Bitcoin from a technical perspective, you looked at what happened in April, there were three lows at 84, 76, and 78 in between. And where we've seen is just that first rebound off that 84 level. I think Suva has really kind of pointed it out very neatly to say that the fear index is on the side of fear, and that this rebound is actually just what we call a relief rally. Having said that, I think technical levels are very interesting. We are exactly at where I think it's going to be a very a key point. If Bitcoin can reclaim some momentum over here, we could see a kind of a different regime coming through. The VIX has also come off a high vol regime, so that actually adds to the risk sentiment in general. And if you looked at how the whole year has been, generally most people have been on the sidelines, and I think this is a great point for those who are kind of underdeployed to really look at some entry levels.
Yeah, but there is fear, as we said. There is, going with the fear index. In terms of the liquidation, right, Melvin, I'm just wondering, where did we see the pain the most? Is it the long positions or not?
I think most liquidations came about because largely there are people who are holding leveraged positions. I think this is typically what happens when the market goes into a euphoria moment. We did go into a very big sector of much positive news, whether it is digital asset treasuries or we're talking about IPOs. I think there were a lot of positive news being brought into the momentum, and this tends to lead to kind of pockets where there's no liquidity. And I guess this is what exactly happened recently. I think also what compounded to that was really generally risk markets were having a bit of a cold, and what happened from AI and the NASDAQ and tech and stocks in general has kind of flowed across. In fact, we've seen that their correlation is relatively positive, which does mean that macro environments are actually driving some of these.
I'm wondering, because earlier Suva was talking about how money's getting parked, capital's getting parked in stable coins. That shows extreme fear, but yet you say that this is the time to be finding opportunities. Where are the opportunities?
Yeah, I think, at the biggest point of fear, which is where 84 was, I think there was a good opportunity. I think at this point, risk is actually pricing more downside than upside in general across the volatility market, across all asset classes. So going into December, I think everyone's a bit nervous about what the Fed wants to deal with and what's going to come out of that. But post that gives you quite a clear runway for risk to be constructive. The risk we see here is more to the upside in the event that it crosses and positive news comes out of the Fed. I think a lot of people will be piling into some of the risk assets. So I think if there's any pullbacks, I think we've got to watch back at where the 84 levels are. So between 84 and 93 will be two very, very pivotal points.
If I can ask one question, Mel, about, you mentioned about the positive momentum also piling up. Already, traders are saying that the Fed rate cut is quite priced in for next week. Where do you see this fresh capital really coming? What the specific segments you expect the fresh capital to come in? And how has the QCP's order book panned out in this recent turmoil?
Yeah, very interestingly. So if you would have looked at the markets in recent times, everyone's been trying to re-enter the market using derivatives. That represents a lack of actual confidence that this is indeed a kind of a turn of the market, but it's also showing that people are willing to dip their toes. And so from the data that we have and from the positions that people have been putting on, we see that. Now what needs to convert is these derivative positions turning into cash positions, which is what you're talking about, ETF buying, cash buying. And I think that's something that could be quite a quick switch. When we talk about the Fed being priced and it's pricing about 80% of a cut, I think we're looking for more guidance. We're looking for the fact that data is coming through, and how does that feed into the overall risk sentiment. What I've noticed in recent times is that there's been a fair bit of sentiment to kind of think that there could be a Goldilocks scenario being priced in, and markets are starting to show that. The rebound in NASDAQ does indicate that. And when that happens, I think risk doesn't happen and risk happens very quickly.
In terms of risk, do you see systemic risks in the crypto space right now?
I think one of the biggest risks in the digital asset space and in crypto in particular, it's really about education. And I think how do we reduce the amount of speculative flows that reduces the kind of liquidation scenarios that we see. I think that doesn't create, that adds to the volatility, that doesn't create the confidence. I think how do we get people to put the money at the right places and take the better risk reward trades is really what this is. And as I explained earlier, you know, sometimes using derivative instead of cash positions at the start is one way that you can help minimize the downside risk and reduce the kind of volatility that you have.
If I can just add one question on this specific on risk, Melvin. So you have been QCP is also a big market maker for digital asset treasuries, and we saw in this run that how digital asset treasury, the risks are kind of, you know, percolating through digital asset treasuries into the broader financial system from crypto as a whole. So what is your sense about this particular aspect of risk? How is it going to kind of pan out for the broader financial system through the DATs, the so-called DATs?
Yeah, I think the digital asset treasuries represent an opportunity for people to get involved in a way that's going to be far efficient if they believe in the strategy of it than a traditional ETF. What I think is probably the risk that people are talking about, which I doubt will happen, is that the mismanagement of these digital asset treasuries. I think if you looked at what's been happening recently, I think the confidence is coming from whether management has the ability to carry out the strategy and execute it to point. I think this is where you're going to have a kind of a separation of quality. And like we look at stocks in general, we have quality over, you know, less quality income. So I think you're going to have that kind of differentiation. I think it's part of market maturity. And this is something that, as investors, we always have to be very mindful of and pay attention to these things, because it's not necessarily just an execution role. It's actually a risk management role, and it's got to do with governance and principles.
And speaking of governance, has the crash exposed perhaps the need for greater, I guess, deeper regulatory oversight and also investor protection?
Well, I would say that if we looked at what the digital asset treasury represents, it does represent sometimes other companies that are having some similar strategies, and it could be a single product company, right? Hypothetically. So whether it's coming from a governance standpoint, from a regulator, I don't think so. But I think investors should be educated about governance from a shareholder investor perspective. What do you expect out of the management? It should not be different from a very big corporate. I think that's the expectations I think investors should have. At this point, sometimes the risk-reward is imbalanced because people are very fixated on the reward. But I think there is still a fair amount of reward.
It's called greed, I think.
Well, to each his own. But I think the point I think I'm trying to make here is that actually it is about risk-adjusted returns. And some of the risk here lies in management governance, and these are some of the things as investors we always have to watch out for.
Is there a key lesson to be extricated from the crash that we've seen in the crypto space?
I think the key lesson that everyone should always be focused on is there too much leverage on your positions? Is there something that you stomach? If you looked at the volatility of Bitcoin and you understood what it meant, you would understand that there are days that these days can happen. And would you want to be liquidated out of your position? And that typically is what we understand as fear and greed. And so how do we stay centered and 2 feet on the ground and grinding every day, focusing on these issues, I think are very fundamental things that investors should pay attention to.
What are the key triggers, Melvin, you think that could turn the needle to a kind of a sustained recovery in 2026? What are your key metrics that you're key triggers rather, key factors that you're looking at?
Yeah, I think this is a very good question. And looking at a correlation of where Bitcoin is with macro assets, I think the key factors will really largely be along these lines. And if you think about where inflation is, and you think about where growth is, I think these are the two big factors that we're looking at. We're actually in a phase of the market where we're trading without much data.
But what about the crypto-centric factors? Anything specific that you're looking at for 2026?
From a crypto-centric factor, I think it's really just general confidence in the market for what we deem as let's talk about whether digital asset treasuries have actually gotten the governance right. And I think these are some of the things that will come out. Are digital asset treasury firms looking at long-term sustainability as a concept? I think once all these get nailed down, we will get there. But if you look at these topics, right, it's also the same for artificial intelligence. I think the both have similarities, and it's just that sometimes the volatility of the underlying asset does create a lot more noise than it should. But if you look at both asset classes, I think the same principles have to apply.
As you take a look to take position, how do you think about hedging?
Well, I think hedging is a necessary part of this, and I think if you were running a company today and you've got some effective beta to economic factors, then you have to run hedges. Any business would. And if you're not thinking about that, then I think you're never going to outperform the market, and you're never going to be more than beta, which does mean that then you are susceptible to challenges when that comes. So for me, when I look at running the business, we look at what can happen, and we try to hedge out those scenarios. And if you look at life, we do that too. Life insurance is an example of that. So I think hedging is a part of life. I think we don't talk a lot about that enough. But that's also why we're in this business. We focus a lot on derivatives as a business, because we believe that that's actually one of the tools that you need in your armory to manage a highly volatile asset.
For those of us trying to look into the crystal ball and guessing where Bitcoin is going from here, where will Bitcoin be at the end of 2026, you think?
Well, the macro environment's a bit cloudy at this point. And if what our projections do play out, we do see some turbulence next year. So if we can be above where, last year we finished about 90 odd, and if we can be above 90 odd, that would be quite good. That would mean that the asset class and the natural adoption still kind of weathered the negative beta. So I think if we can do 90 to 100, that would be great.
Seems pretty conservative to me. Anyways, yeah. Mel, thank you so much for that. Subantu, Melvin Deng, CEO of QCP Group, and Bloomberg's very own crypto reporter, Subhashri Ghosh. Still to come, Hong Kong builder New World tries to get more creditors to accept cuts as a deadline for a bond swap plan looms in the next hour. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Bearish bets on China Vanke shares climbed to a decade high in Hong Kong this week, following a surprise request to delay a local bond payment. Bloomberg Economics thinks a potential default could wipe out any remaining belief in Beijing's implicit backing for the sector. For more insight on the long-term gains and short-term risks, Bloomberg economist David Chu is with us. David, I mean, who would have thought that the collapse of confidence would go even deeper from here?
Well, yeah, we have to say that the collapse over the confidence on China's developers started from 4 years ago when the Evergrande defaulted its bond, and that actually broke the belief of too big to fail. Now, when it comes to Vanke, because Vanke is a special one because the market believes that it is some kind of quasi state-owned enterprise, because the biggest shareholder of Vanke is the Shenzhen Metro. So that if Vanke defaults, that means a new phase of the credit problem in China's developers' credit market. So yeah, I think that is why people are looking at it.
Is it inevitable that the government will back away from backing Vanke? And what are the implications of that?
Well, we cannot bet on that, but we think that it may be a window of time for the government to reconsider their backing to the corporate sector, the property sector, especially developers, because we have seen the drop of the importance of the property sector in the GDP, in the economy. And also, after several years of default, the market has largely priced in the credit stress in many of the developers, so that it provides a window for the government to consider cutting their implicit guarantee to developers. However, they have to balance what is going to happen in the property market, because it may weaken the confidence.
So, David, what are you looking out for in terms of, shorter term as well as long-term risks?
Well, in the short term, maybe China will have another round of drop in home sales and also investment. In this particular time, when China is suffering from inadequate demand, it means a drag to the economy. And that is what we are worried about the short term. In the longer term, I think the beneficial side could be bigger, because the government don't have to bear the potential cost for bailing out the developers, and they can focus on the structural reform of the economy. So, but anyway, we are not the policymakers, so we are not the one to make the decision. But anyway, I think the policymakers need to consider both sides.
David, thank you so much for that. Bloomberg economist David Chu there. Meantime, Hong Kong's New World has just a few more minutes on the clock before the deadline for a key bond exchange plan. The builder has given holders of certain bonds until 12:59 p.m. Hong Kong time to decide whether they will agree to a swap for up to $1.9 billion of new debt. For more, China credit reporter Trista Sinyi Luo joins us now. Trista, what's at stake here?
Yeah, so we are almost there until the deadline. New World given its bondholder to, say yes to this up to $1.9 billion debt swap plan. As of November 25th, actually 69% of that targeted amount of new debt was already swapped. So we need to, wait for the final result coming from this debt swap plan. This debt swap plan is actually New World's latest move, trying to, relieve its liquidity pressure. Earlier this year, we see New World managed to seal a mega refinancing deal with banks in Hong Kong. And then later on, they also managed to secure an over $500 million loan backed by Victoria Dockside, its crown jewel asset in Hong Kong. But we need to remember that New World is still far from out of the wood yet. It still carry more than 200 billion Hong Kong dollar of liability. So that's why we are seeing this debt swap is undergoing.
So I guess the question really is, what's the risk of default for New World now?
I won't say we see the immediate, default risk there for New World. And I think right now we are seeing what they're gonna do next for its debt, because it still have lots of debts there. I think investors right now are watching closely, like what New World would do next after this debt swap plan. Will there be any capital injection plan coming in, or will they roll out another round of liability management exercise? And our team is also watching closely about whether there will be any sizable asset disposal coming from whether New World level or the family level.
A key question is whether or not the property market in Hong Kong and China will bounce back. And if you take a look at the latest data, there's really no sign of that happening. Isn't that true?
Yeah, I think especially for the commercial real estate side, I think people are still a bit pessimistic about that. Although on the residential side, I think some analysts are telling us it might reach the bottom yet. But I think overall the sentiment is still not that great there. So we really need to wait and see how the property market moving forward into 2026.
So what are you looking out for, Trista? What's expected in the coming days?
Well, for New World per se, we definitely watch closely about the result, the final result coming in, because as I mentioned earlier, we already see 69% of that agreement. So we will see whether they can see how much they can achieve finally, right? And then later on, definitely what New World will do next after this DAF swap plan, because even with full participation, New World still have some perpetual bonds there with a dividend stopper. That's a key thing investors are watching, like how New World will deal with those perpetual bonds. And then also, as I mentioned earlier, whether there will be a capital injection plan coming in.
How much clarity is there for 2026? We have already seen record defaults on the back of the property crisis. Do we know what's the outlook?
I think especially with the Vanke news happening recently, I think people are still a bit, confused and wondering what will coming in the 2026. So I think right now people are still taking a very cautious stance on what's going on in the new year. Right. Especially, in mainland, we see that some of the key data people are watching right now actually is not there yet. So I think right now people are really taking, a closer look on this.
Bloomberg's China credit reporter Trista Sinyi Luo. Now, before we go, here's a look at our guests for tomorrow. NTT Data CEO will be joining us. Keep it here with us. This is Bloomberg.